Welcome to the Phoenix Prosperity Podcast, where wealth meets legacy. Join your host, Tim Fergestad, as we explore the journeys of Phoenix's finest to success and beyond.
This is Tim Fergestad. Thank you for joining us. Joining me today is a good friend, Randy Smith, a seasoned capital raiser with 25 years of sales, leadership, and investor relations. At 5210, he connects accredited investors with low volatility, high yield mobile home park opportunities built for cash flow and tax efficiency. Welcome to the show, Randy.
Glad to be here, Tim. Always great to support a fellow capital raiser.
Heck yeah. Now, why don't you rather than give a background on investing in general, let's dive right into 5210. Can you give us a little background on kind of their history and their scope?
Yeah. So 5210 is an operator in the mobile home space. We currently own and manage 12 parks across 5 different states.
Okay.
We are based here in Arizona, so a large portion of those parks are here in Arizona, as you
Yes.
know. The co-founders, Jack Martin and Nate Petty, both have probably about 20% or 20 years or more experience in various real estate related activities. Jack came up through the fix and flip community. I think he flipped over 1,000 houses
Oh,
before
wow.
getting into multifamily and then ultimately found mobile home parks almost 10 years ago now. And Nate came up through construction management and then ended up in the multifamily space. And then he and Jack formed 5210 in mobile homes. So, yeah, we're a mid-sized mobile home operator. We focus on a value add strategy. And our goal is to own 52 legacy assets over the next 10 years.
Okay, that's awesome. Now,
Yeah.
um, one went through fix and flips to mobile homes, other went through multifamily, and then they sort of teamed up. I always think of mobile home parks as sort of a subset of multifamily. For our listeners, maybe new to the space, can you discuss how mobile home parks fit into the broader category of commercial real estate and what makes
Yeah.
them maybe
Yeah.
similar and or different from traditional multifamily?
Yeah, good question. So, I will say that even within the mobile home park space, there's a number of, just like any asset classes, there's a number of different strategies and a number of different ways to participate in the space. But mobile home parks, essentially, as an owner, we own parking lots. And the people that park their homes on our parking lots pay us rent, just like you might as placing or putting a car in a parking spot. So the beautiful thing about mobile home park investing is that the mobile home owner will generally stay in that same spot for an average of about 15 years or so.
Okay.
And that really brings up one of the biggest differences between multifamily and mobile home parks. And the reason for that is the average tenant in an apartment complex might be there for about 18 months or so. Whereas, as I mentioned, in the mobile home space, it is about 15 years. So,
That's the tenant themselves, not the actual mobile home or the structure. The structures, they're
yeah.
probably even longer, right?
Well, no. So, that's a really good designation that you bring up there. So, you have two different types of renters within a mobile home park. You've
Okay.
got the lot rent. So, if you own a home that is placed in a mobile home park, you pay a lot rent, and the average lot rent might be about $500 per month, depending on the market.
Okay.
Um, it is possible to own mobile home parks where the operator actually owns the homes as well.
Hmm.
But we at 5210, we prefer not to own the homes because this is a very quickly depreciating asset.
Okay.
And we believe that it makes more sense to sell those homes, or even in some cases, give those homes to the people that are paying the lot rents, because we don't want to manage the upkeep, the
Right.
renovations of those homes. We want to just manage the lots, the structures, the common areas, those types of things.
Okay. Utilities and water
Exactly.
drainage, right?
Exactly. Yeah, or a clubhouse. A lot of our parks have beautiful pools or maybe dog parks and playgrounds. All the same type of external amenities that you might get in an apartment. We just don't have to deal with all of the upkeep of the actual building itself or the
Right.
the
Right.
rentable units themselves.
You,
Yeah.
right, right. And prefer not to. If you ever do, you probably try to sell them or give them, like you said. But back to sort of the tenant aspect. So, long-term tenants, that's awesome.
Yes.
Anybody in real estate can appreciate that. Um, but maybe a little bit more on the differences between just the tenant terms.
Yeah, tenant terms, we have standard leases on these, just like you would in an apartment complex. Um, One of the benefits of the mobile home space is that if for some reason a tenant decides they want to move, they have a very large expense in moving the mobile home. So
Hmm.
quite often people will stay, they're not going to end up moving a mobile home for a 3 or 4% lot increase. Um, because it probably costs 8 or 10 or even $12,000 to move it. So that lends itself to really stable income and predictable
Hmm.
income
Right,
from the investor standpoint or from the operator standpoint. Whereas in the apartment space, if somebody gets a 4 or 5% increase year over year, that could
right.
be as much as $100 or $200. And people are willing to, get their buddies in a truck and,
Buy him some
buy
pizza and
buy some pizza and beers and they're off to the next apartment where
right.
in the mobile home space it's just not that easy.
Okay. Can you talk about some of the key drivers behind the demand for affordable housing and how mobile home parks are positioned for that?
Yeah, and so yeah, we all hear this talk about affordable housing, and you'll see that quite often the blue collar renters in apartments, they say that this is really affordable housing. But I can share with you, like here in the Valley, in Phoenix, as an example, you might be paying 15 or $1,800 a month for maybe a C class apartment,
Hmm.
whereas in a mobile home park, you might be paying 500 or $600 lot rent, and then if you own the home, that's really the only fee or the only monthly expense that you have.
Right.
So mobile home is actually the most affordable housing option in most markets. And specifically in the markets where we choose to operate, we want to operate in MSAs or in markets where the median home value is going to be 300,000 or $350,000 because we want the next cheapest affordable housing to be a house in the 300 to 350 range. So there's a big enough gap between renting a lot with us and then owning a home versus going out and buying the next cheapest available option. So it truly is the most affordable housing. And what you find is that institutional capital is flooding to this space because of that stable, predictable income combined with the outsized tax benefits that come along with it as
Okay.
well.
Right. Right. Can you speak a little bit too, but since you mentioned it, sort of the different range of classes of mobile homes? 5210 seems to have a criteria for ones they want to do and don't want to do.
Yeah, so different from multifamily, you hear A, B, C, D class in
Right.
the multifamily space. In mobile homes, for some reason, they don't use A, B, C, and D. They use a star rating. So
Okay.
1, 2, 3, 4, and 5 star ratings. So
Okay.
we focus specifically on 3 star parks because they're not the nicest parks. These can be resort style parks, but we have a tendency to really focus on 3 star parks with the goal of shifting them up to a 4 star park. And the
Okay.
reason for that is, of course, 1 and 2 star, very similar to D class apartments. It's a tenant class
Mhm.
that we don't have a very strong desire to serve. And it's the classic trailer park that you think of when you think about old
Sure.
ugly trailer parks. So 3 star parks generally are going to have blacktop roads, which is unique when you start looking at lending because the Fannie and Freddie fixed rate, the best debt that you can get out there, they're going to require actual blacktop roads. They don't
Oh,
like
really?
dirt
Okay.
roads like some of the others. So we focus on that spot. We can take a 3-star park up to a 4-star through our value add strategy and bringing in new homes. And that's really where the long-term wealth generation is created.
Okay. And on that note, can you talk about some of the value add business plan improvements you guys make, and then probably the tax advantages and yields that come with that?
Yeah, absolutely. So, value add strategy is much like multifamily. Ultimately, you're doing everything you can to improve net operating income, and that can be through a combination of rolling out our internal property management and asset management, policies and procedures and techniques. That'll help to decrease expenses and maximize revenues because we try to
Right.
take advantage of every revenue stream that we possibly can, whether it's renting out office space in the clubhouse or adding storage facilities or charging for covered parking, all of the same types of things you might do in any asset class. But then what is unique in this space is if the easiest way, maybe not the easiest way, um, a way where you can significantly impact NOI very quickly is by filling up empty lots with new homes. So
Okay.
if you if you bring in 5 or 10 new homes and you weren't getting a lot rent on those homes before, and you do now because you put a new home on there, that's going to increase your NOI immediately. So if you have a good sales team, either internal or external, that can buy these homes, market these homes, and sell them to end homeowners, that's going to increase your NOI dramatically. Now, something that we choose to do in situations where it takes us time to actually fill up those lots is we'll open up those lots to midterm rentals with RVs. So they might come and stay with us for 3 or 6 or 9 months or even a year plus. But we ultimately want to replace any empty or RV lots with long-term mobile home owners.
Okay. Okay. So you like other sort of properties, you go in, you try to make it better, cleaner, safer. Sometimes that's more lighting, but more attractive. People you get people willing to pay more for the community, but also
Mhm.
uh, providing housing directly. So do you through your affiliates offer your lots at a discount to get them in there in the first place, or do you buy them yourselves and then try to sell them once they're on site?
Yeah, good question. And answer is everything. We do
Okay.
anything and everything we can to sell homes. We will do partnerships with the home builders themselves. We will do partnerships with external third party sales organizations. Our on-site staff is constantly trying to sell homes as well. So we really come from a multi-pronged approach trying to sell those homes because
Okay.
ultimately, um, that stable, predictable lot rent creates stable, predictable income and NOI, which ultimately our investors end up appreciating with
Right.
their regular quarterly distributions. Yeah.
Is it similar to apartments in the sense that sometimes when we remodel apartments and the tenants don't want to move, but we still want to remodel, we give them the option to move into the new unit? Do you guys ever do that with existing tenants? You then sell, and then they can move on. You help them move into a new one, and then rent out their old one, or try to sell it for them.
Yeah. And I'm glad you bring that up because it is, I mean, it very much is a people business. And
Hmm.
our goal is not to move into a market or take over a park and, jack up the lot rents, in month or in year one. And then we got really unhappy tenants. Our
Sure,
goal is not to do that. We
sure. But you're
ultimately
filling
want to
up vacant lots. That's a no-brainer.
Absolutely. That's a no-brainer. And even just regular lot rent increases, we want to do that over a few years.
Right,
And before we even start increasing rents, we want to add value to the park. So those tenants that do plan to stay with us long term, they're going to see the value that we're bringing to the park before they ever get a rent increase from us.
right.
So now it is kind of interesting that there are um, once a home gets to a certain age, um, it starts to really bring down. kind of the overall feel of the park
Right.
itself, right? And ultimately, we'll do an assessment when we move into a new park or take over a new park, and there are certain homes that we're going to ultimately want to get rid of,
Okay.
and we will take
Broken
steps to move those
windows and
people.
such. Yeah.
Yeah, just skirting missing, the old 1960s style that looked kind of like an RV with a trailer hitch on the front. Um,
Right.
Ultimately, as we're bringing in new 120,000 dollar homes, the people that'll buy $120,000 home don't want to have those type of trailers essentially next to them. So
Right.
we'll find a way to make those type of situations work for everybody involved. I mean, we're never just kicking people out unless they're not following the guidelines in their lease
Right.
agreements and those types of things. But it's kind of interesting though. Like, is there are some mobile homes, and we can talk a little bit about how the number of mobile home parks is actually decreasing year over year, and that's because as these homes start to age out, you can't move them because there's HUD requirements to move a new or to move an old home, and a 1960s mobile home won't meet those requirements to move them to another, maybe a lower quality 1 or 2 star park. So
Okay.
ultimately, what ends up happening is they end up getting either trashed or destroyed, and or we pay somebody to take it away. And there are programs in place that can help those tenants move into other type of housing as well.
Okay. Okay. But it's that the cost of home ownership is at an all-time high, and
Mhm.
the affordable housing is in short supply. So these are challenges for operators today, right? Limited
Mhm.
inventory. As you said, there's fewer parks now today, and a lot of people don't want them infill parks into an urban area. So, uh,
Mhm.
how are you guys dealing with those challenges and community resistance in that sense? Where are these new parks? Are you building new ones or just renovating existing ones?
Yeah, good question. So, yes, to your point, like most municipalities are not approving new plans for mobile home parks. It's very, very limited. In fact, I think it's about a 10-to-1 ratio, the number of parks that actually get kind of bulldozed versus new parks that are approved on
Oh,
an annual
really?
basis. So for every new one, there's probably 10 that are getting scrapped for
Wow.
higher and better use ultimately,
Sure,
right?
sure.
And when you look at it from the municipality standpoint, there's good reason for that too. Like, of course, we've got NIMBYism, so people don't want mobile home parks in their backyard. Certainly, trailer parks they don't want. Some of the nicer resort style might be easier to get approved, but people don't want mobile home parks in their backyard. When you couple that with some of the challenges that it presents for municipalities, the tax income stream to a city is significantly less for a mobile home park than if you were to put a similar number of lots or units of apartments or something else that is there. So, from a tax revenue standpoint, municipalities would rather have higher density, higher cost homes because they make more money, right?
Right.
So that comes into play certainly. Um, and then when you start looking at there's all kinds of variables that cost brings into play because they have the same fire or fire department, police department, school requirements are based on headcount. It's not based on the number of lots quite often. So it makes more sense for them to go with something that's going to bring in higher tax revenue to support those services.
Okay. Okay. Before we get into sort of the tax benefits and the yields and stuff and why these are popular,
Mhm.
can you talk a little bit more about the operational struggles and wins for the team, I guess, right, across the portfolio?
Yeah. Yeah. So it's an interesting space when you start looking at property management in this space. Um, a lot of folks will get into mobile home thinking that they can do or leverage third-party property management. Third-party property management is really difficult in this space because that standard 8% of rent is going to be significantly lower in a mobile home park than it might be in an apartment complex. And
Sure.
it's just the simple math behind 8% of a $2,000 apartment or 8% of a $500 lot rent, that's going to give you a different type of person or property management company that you're able to source for that lot or for that facility. So third
Well,
party is very difficult.
I imagine 8% is a little high considering they don't have all the same issues they have to deal with themselves, or is it still very, very hands-on to, because right, they don't have to fix their homes or their toilets when they leak, but it is a community problem they still kind of need to deal with.
It is indeed. Yeah. So yeah, it's interesting. A lot of people think property management would be a lot easier in the mobile home space, and it's just not. The reality is you have all the same issues, whether you're managing the renovations yourself or you're having to manage the owners to get those renovations done.
Uh,
They still have to be done, and you still have landscaping and all of the normal issues that you would deal with that as well. Um, so the short answer is you've got to bring property management in-house. And
okay.
anytime you bring property management in-house, then it brings on all the same type of challenges you might have in multifamily, which is you've got to be big enough to where you can have on-site staff.
You
You
can,
probably need to have on-site maintenance as well, like you would in any apartment, unless you have enough parks that are close in proximity to one another where you can share those resources across parks, like we do in some of our markets as well.
okay.
Um, but yeah, we do a lot of stuff around community events. I just got a whole bunch of pictures around Halloween and Thanksgiving pictures, and
Right.
they do the back to school drives, and we're really trying to create a community that's going to attract the type of renters or renters or tenants that we want, because they're going to stay with us so much longer. So
Right.
what you find is you see kids playing outside a lot more. You see neighbors that are out talking to each other much more because it's not this transient population that's getting turned over every 12 to 18 months or so.
Right. Right. Okay. Very cool. Very cool. Who's an ideal investor for mobile home park investments?
Yeah, so ideal investor is somebody that's looking for stable, predictable income that might have a tax problem. We have significantly better tax benefits in this space than we do in other asset classes. Um, an ideal investor for 5210 is not somebody who's looking for the quick flip. We are not a flipper of mobile home parks. We hold our parks generally 7 to 10 years plus.
Okay.
And we can get into why we do that if that makes sense. But we're not looking for folks that are looking for a 2 or 3 equity multiple in 24 to 36 months. That just doesn't align with our strategy. Um, and it's folks that are generally more sophisticated passive investors that have been investing in other asset classes. Mobile
And they've
home
learned to
park.
appreciate the conservative nature of this play.
Exactly, exactly. So, like myself included, my very first passive investment was a mobile home park. And then I got distracted and got lured over to the multifamily space where everybody was getting these huge returns real quickly. And I ended up ultimately coming back because as my sophistication level is increased
Right.
and my knowledge and expertise in the area is increased, I know that I want consistency, I want stability, I want good tax benefits. Um, my risk profile is different from those that are chasing the very, very high yield. So,
Right. Right. Wait, let's talk a little bit about the tax benefits. What makes
yeah.
them so attractive?
Yeah, so when we look at this, has been a great year for us because of the big, beautiful bill brought back bonus
Mhm.
depreciation. And what that brings back to this market specifically is investors can expect to get anywhere between, I would say, 140 and 170% passive losses year one,
Wow.
which is 2, maybe 4 times bigger than what you might get in multifamily or self-storage or industrial or office or really any other asset class. And that has a tendency to attract a certain type of investor as well, where if they can take advantage of the taxes, the tax benefits that come along with this, the yield is less important. And I'm
Right.
usually helping folks with tax challenges more so than big equity multiple that they're
Right.
searching for. So
Yeah.
now, the reason that occurs in the mobile home space is because when you are doing a cost segregation, they break the cost segregation down into the price of the land, the price of the building, or buildings, and then the price of the land improvements. And the easy example shows that let's just keep the land price the same. The land is probably worth
Can't
the
really
same whether it's
depreciate, right?
an apartment or whatever the asset class is. And that might be, call it 20 or 30% max for the land. Let's say
Okay.
20% for easy math. Now, the next component, when you start looking at buildings, especially if you don't own the homes, which is our goal, the percentage that is allocated towards building in mobile home is generally very small, probably only 10% of the acquisition price. Whereas in an apartment, that accounts for about 60% of the asset price.
Okay.
So with apartments, you've got about 80% that's tied up between the building and the land. In a mobile home, you might only have 30%. So what that means is when we go to do our cost segregation, 70% of the acquisition price is depreciable um, with a cost segregation, and we can take advantage of that year one. So we're able to get on the most recent cost segregation study that we're just completing, we're going to have about 155% passive losses because of that variation
Right.
in the land
Well,
improvements.
so there's a lot of depreciation, and the reason it's over 100% is because you guys use leverage when you acquire these.
Exactly. Yep. So if we've got, let's say on this last deal, we bought $11 million park, we have $7 million in losses. And if we only raised 4.5 million from investors,
Right.
the $4.5 million in capital will get $7 million worth of losses. So
Right.
that's how that works. Yeah,
Right. The lender doesn't get to partake in that, which is for our listeners so they understand how you get more losses than you bought.
absolutely. And we as operators don't take the lot or don't take the passive losses either. We give everything to our investors.
Okay.
So yeah,
That can vary from project to project in some places. So
absolutely it
that's
can.
good to know too.
Absolutely. Yeah.
Okay. Okay. So you mentioned the longer time frame. Can you want to give us a little more insight onto why 5210 likes to hold a little longer?
Yeah. So when I think back about my own investor journey, what I got really excited about and why I ended up moving away from mobile home initially was I wanted those big equity multiples
Hmm.
and the big IRRs. The challenge with the big equity multiples and IRRs in a short amount of time is that as soon as you sell that asset, you've got a tax problem all over again. And
Sure.
what I found were people were actually making bad decisions on the back end to reinvest into deals again, or having to very quickly go find other investments that they could invest in. Otherwise, they were going to get a huge capital gains tax bill at the end of the year.
And they're very subject to market cycles.
And they're subject to market cycles. Yes, we don't want to get into that. Well, I guess maybe we do want to get into that, but we
Right.
could have a whole
Well,
different
you hold
episode on
longer,
that.
you have more options, more flexibility, a much safer thesis or model.
That's it exactly. Yeah, that's it exactly. So, our thesis is that we want to acquire cash flowing assets from day one. Our goal is to be able to pay our investors 4, 5+% year one, while also giving them, call it 150% passive losses year one. Okay. So out of the gates, they're getting tax benefits and cash flow. Years 1 through 3, we're going to stabilize this asset. We're going to execute our infill strategy. We're going to clean up operations and maximize NOI with
Yep.
the goal of doing a refinance or adding the supplemental loan at year 3, maybe year 4, depending on what's going on with the capital markets.
Okay. And
And
what are
when
the
we,
advantages of that?
well, the biggest advantage of that is our goal is to give all of our investor capital back to them, which essentially takes all the risk off the table. So if I've paid you 5% a year for the first 3 years, and then I give you all of your capital back, and you maintain ownership in that asset for the next 7 to 10 years and continue to get cash flow, you can now go deploy that same initial investment into another deal and start that process all over again. It's possible to have the same 100 grand working for you on 3 different deals over the course of 10 years and
Right.
continuing to get passive losses each time you deploy that $100,000 or
And
250 or
and
whatever that
growing
is.
your passive income portfolio.
Exactly. If you're getting 5% on each, now all of a sudden you're getting 15% because
Right.
you've got it across 3 different assets, right? So, and your equity continues to grow. Now, we're not. people talk about the infinite hold. Um, and I don't know that there ever truly is an infinite hold, right?
Right.
Let's be real. At some point, the market's going to present us with an opportunity where we can't say no to selling this asset, and that's where a lot of the mom and pops that we're buying from are starting to fall into that same thing. Like at some point, it doesn't make sense for them to keep the homes anymore, regardless of what the tax consequences are. So at
Right.
some point, you're going to sell the asset, um, and at that point we can go out and buy newer, prettier, bigger properties and continue to move up in quality at that point. Because as you move up in quality, management, property management, asset management gets easier and easier.
Right. Okay. That all sounds super exciting. Now, in terms of doing due diligence, right, on operators and opportunities, what should investors be thinking about?
Yeah, so probably my biggest personal lesson in the last 6 years has been everybody says you're betting on the operator, you're betting on the jockey, not on the horse, right? So you got to
Hmm.
find the right operator. And I think that's really easy to say. It sounds cool, right? I'm
Right.
betting on the jockey, all of that stuff. But how do you vet the jockey, right?
Yeah.
The easiest way is to look at track record.
Hmm.
But important when you look at track record is you look at track record of that person doing what they say they're going to do in the market, not the physical market, but the economic market, the economic cycle that they're in today. So somebody who went full cycle on 10 deals in 21 and 2020, that doesn't necessarily mean that they're a good operator in 2025 or 2026 and beyond. Okay. So
Right.
the folks that were here before 2019, 2020, 2021, and the ones that are transacting today in a harder market, I think it's important to look at those. And probably the single most important thing that I figured out was that I needed to verify that the operator's current portfolio was performing at or above goal. And that's difficult to do. But a
Right.
way to do that is to ask for investor updates. Like
Hmm.
I would literally go to every operator that I was looking at partnering with and say, I want to see your investor updates for every single one of your deals. And for some of these groups that had 50 or 60 of those, that was quite a task.
Yeah,
But
that's a
what I
big ask.
found, yeah, what I found though is the operators that were performing well were eager and excited to share that information. And it was a
Sure.
very easy process, right? Like 5210, I can get you all of those literally in 90 seconds if you want them. Because we've got nothing to hide and we're performing at or above goal.
Right.
So that's what I
And you're
encourage
running a
folks to
good
do.
ship. You have all your systems in place.
Yeah. And these are lessons I learned before finding 5210. And I think we didn't get into this earlier, but the way that I found 5210 was I was a fund manager that was managing capital for my investors for 3 years and my own capital. And I
Hmm.
started vetting 5210 and made the decision instead of just bringing their deals to my investors, I decided to join the team
Right.
because I was so impressed with what they were doing. So, yeah, I think the vetting of operators is really important, but your sophistication in that process needs to continually improve. So
Right.
find groups that'll help help you with that process, teach you in that process, and probably more importantly than anything is get referred to those operators from somebody else that's already invested with them.
Ah, that too.
So,
Yeah.
yeah,
Yeah. Transparency is a big one though, for sure. For sure.
yeah,
And just for our listeners who may not understand the bet on the jockey, not the horse, a lot of people want to know in real estate about the project. They want to know about the property. And Randy and I can both probably tell you that we've seen good properties get driven into the ground by bad operators. And we
absolutely, yeah,
and we've seen good operators rescue bad properties, right? So yeah, you want to partner with the proper operators for sure.
yeah, absolutely.
All right, Randy, thank you very much for sharing all that. Mobile homes, exciting stuff. And although there's fewer of them every year, right? That still at a super attractive investment class.
Absolutely. Yeah. Well, very good. Fun
All right.
conversation, Tim. Like you and I, we have obviously been working together for a few years, and
Yep.
it's been really cool to see your expertise and sophistication continue to improve. And for the folks that are listening and considering partnering with Tim on projects, you definitely have my seal of approval. But
Thank you.
yeah.
Thank you. Now, Randy, if people want to learn more about 5210 or reach out to you, where can they go? What should they do?
Yeah, so 5210 is our website. We've got some great resources that are available on the website. I'd encourage you to take a look at those.
That's the number 52 and the letters TEN.
TEN, yes,
Okay.
52ten.com. And I'm on LinkedIn as well. So that's probably the quickest way to get to me. But certainly our website has a lot of great resources as well.
For sure. All right. Thank you very much, Randy, for sharing your time and your insights into the still booming. It's always been good. It just keeps getting more and more popular for lots of good reasons, like you just shared. Thank you for sharing all that.
Awesome. Thanks so much for having me, Tim.
Inspired by our guests? Visit phoenixprosperitypodcast.com/guest and join us on the show and share your success story with Tim. The spotlight awaits.